Hello, and thanks for joining us for Law in the Library. My name is Robert Reeders, and I'm a librarian in the Adult Services Department at the Headquarters Library. The Alachua County Library District and Three Rivers Legal Services have partnered for over 10 years on the Law in the Library series. Three Rivers Legal Services is an LSC that's provided free civil legal services since 1978. They have offices in Gainesville, Fernandina Beach, Jacksonville, and Lake City, and provide assistance on domestic violence and family law, housing and landlord-tenant issues, foreclosure defense, money and debt, veterans issues, record sealing and expungement, elder law, hurricane and disaster assistance, and public benefits. Their telephone number is 352-372-0519, and their website is https://www.trls.org. Today's topic is tax laws with Professor Derek Wheeler, Savannah Rankich, and Hallie Young. Professor Wheeler is a legal skills professor and director of the Low Income Taxpayer Clinic at the University of Florida Levin College of Law. Prior to joining UF Law, Professor Wheeler worked in private practice at a boutique tax controversy firm in Western New York. In that role, he worked on high-dollar tax audits, complex litigation, and large collection matters. He also worked on New York State sales tax audits and collection matters. Before entering private practice, Professor Wheeler was the qualified tax expert of the Low Income Taxpayer Clinic for the Erie County Bar Association Volunteer Lawyers Project in Buffalo, New York. In that role, he handled the operation of the clinic, including representing low-income and ESL clients in federal income tax controversies and providing educational outreach throughout Western New York. Savannah Rankich and Hallie Young are students under Professor Wheeler and also participate in the Low Income Taxpayer Clinic. During the talk, if you have questions, please comment and we will follow up. And so I'd like to turn it over to you.
Great. So today we're going to be talking about a variety of tax issues of consequence.
And I'm Hallie Young.
And I'm Savannah Rankich.
And we are both law students at UF in the UF Low Income Taxpayer Clinic. Today, we're going to be starting with some emerging and upcoming tax issues, including what to do about sports betting, how you should report payments to payment providers, retirement savings, and green energy credits, along with House Bill 7073.
Then we're going to move on to some issues about filing taxes for this year and what to do if you have a delinquent tax return.
So to start, we'll start with sports betting. So recently, Florida has legalized sports betting through applications on your phone and computer. The IRS has special rules on what to do with gambling and how to report your losses and winnings. The IRS defines gambling using three elements. There is an uncertain event, a reward if the uncertainty is resolved in one's favor, as in if you win, and money lost if the uncertainty is not resolved in one's favor, as in if you lose. So under this definition, sports betting does fall into this category. So what does this mean for us? It means that the IRS will be taxing you on any winnings from this. The IRS requires you to report your wagering gains, which means the total winnings minus the amount of rate of wagers. You are to report this as other income on your Schedule 1 1040. And typically, if your winnings are large enough, as in at least $600 or at least 300 times the amount of your wager, the casino will ask you to fill out a little form to provide your information, and they will send you a W-2G, which you will report to the IRS. There is some good news. The IRS will allow you to take deductions on your losses and expenses to offset your winnings. This means transportation to and from the casino, as well as any losses arising from the actual gambling sessions, can be deducted so long as you itemize your deductions. If you choose to only take the standard deduction, you will not be able to deduct these expenses and losses. So this could be a huge benefit for you to itemize. The little bit of a limitation here is that your deductions are limited to whatever it is that you won. So we provided some examples here that if you wager 200 total in a gambling session and you win 150 total, you can only deduct $150 in losses. Further, if you wager $100 total in a gambling session and you win $150 in total, you can deduct all $100 in losses. So because the IRS has only provided information on what qualifies as a gambling session with regards to slot machines, there is a lot of ambiguity for taxpayers currently. From the IRS, they state that a casual gambler, such as the taxpayer who plays the slot machines, recognizes a wager in gain or loss at the time she redeems her tokens. This means that if you keep winning, losing while you're sitting at a slot machine, only the total ending win or loss value needs to be reported. This can be easily extrapolated to other gambling activities such as poker, blackjack, or other games where you're constantly entering and leaving rounds. But because there is no real ruling when this comes to applications for sports betting, it could be potentially by day, as in what you have at the end of 24 hours, or whenever you redeem your tokens and winnings. Whatever you do to report these, just make sure that you are consistent and have a good argument to make sure that you can explain your reporting habits.
The next thing that we're going to talk about is the changes in rules around payment settlement entities such as Venmo, Zelle, PayPal, and Cash App. So the IRS currently requires the reporting of payment transactions that exceed $20,000 and 200 transactions. This applies only to payments for sale of goods and services. For example, if you are selling items like on Poshmark or on eBay or one of those platforms and collecting your payments through PayPal, or you sell things on Craigslist. However, it's only if it exceeds these high reporting thresholds, so it doesn't apply to too many people as of yet. However, the IRS is planning to change these regulations to require anyone to report amounts over $600. They were planning to implement that by now. However, they've pushed back that timeline and don't currently have a timeline for when the $600 threshold will be announced. However, they have decided to lower the cap from $20,000 to $5,000. So for the 2024 tax year, meaning the ones that are due in spring 2025, the IRS is going to require reporting any amounts over $5,000. So this will definitely end up applying to a lot more small businesses that may use these payment settlement entities to collect their sales. Again, this applies only to the sale of goods and services. If you're selling your old clothes, your furniture, if you run a small business, this doesn't apply if you Venmo your friend back for dinner or if you're splitting your utilities. So again, this is going to apply to a narrow subset, but will start to roll out and apply to more and more people. So what do you need to do now about this? If you currently are selling goods and services and collecting payment through these entities, you need to give them your tax information. If you do not give them your tax information, they are currently required to withhold 24% of those payments, no matter what your actual tax bracket is going to be. And so it is advantageous to report your tax information right now so that they have the correct amount of reportings, or they have the correct amount that they withhold rather than this 24% figure. The next topic that we are going to talk about is changes in retirement savings. So first, the IRS has changed the rules around IRA and 401k withdrawals. You can now take much more penalty-free early withdrawals from both of those accounts. Additionally, they've added regulations around domestic abuse victims, allowing them to take out $10,000, up to $1,000 for emergencies. However, you still have to pay regular income tax on these payments that you take out. However, you do not have to pay the 10% additional penalty. Additionally, there's new regulations around 529 plans. Now you can roll over leftover funds in a 529 education plan tax-free over to an IRA. However, this comes with a lot of requirements. So if you do plan on rolling over the funds, definitely be sure to look those up and make sure you fulfill all of them. However, the main requirements are a $35,000 lifetime cap, a limit and a per year rollover of $7,000, and you must have held this 529 account open for more than 15 years. Again, these are just the main requirements. So if you do plan on doing this, make sure you look up and make sure you qualify. The next big rule change is that there's no longer required minimum distributions for Roth 401ks, which aligns with the rule for Roth IRAs, and the RMD age has moved down to 73. Additionally, the IRA contribution caps have been raised. The 401k maximum contribution cap is now $23,000, and if you're born before 1975, you can contribute an additional $7,500. And Roth IRAs and IRAs, the maximum contribution has been moved to $7,000, plus an additional $1,000 for individuals aged 50 and older.
Next, we're going to be talking about the changes in green energy credits the IRS is implementing. So in recent years, the IRS has made many changes to move towards promotion of greener actions for taxpayers and rewards for those greener actions. So one of these are the credits they offer for electric vehicle usage. So taxpayers who own electric vehicles or fuel cell vehicles may qualify for this credit. Credits are applied after your taxes are calculated, so they help to lessen the amount you actually pay. Unlike many other credits, these are non-refundable, the ones that have to deal with green energy. So they will not result in your getting a tax refund, but they will help lower the actual taxes owed. So for the clean vehicle tax credit, if you purchased a plug-in electric vehicle or fuel vehicle within 2023 or 2024, you may qualify for this credit. The maximum amount of the credit would be $7,500, and that's under Code Section 30D. And this will go on from this tax season to potentially until 2032. Your vehicle, there are many qualifications that are personal as well as vehicle. For personal qualifications, you need to make sure that you bought this vehicle for your own use, not for resale value. It can be bought for another member of your family, but it must be kept within the individual use requirement. The green vehicle tax is only for new vehicles. So you need to make sure that whoever sold you the vehicle reports the sale online, as the IRS will be using that information to double check that you are reporting the correct information with regards to the vehicle qualifications. There are other small qualifications, but they are mostly about your adjusted gross income, the vehicle usage in the United States, and how much that vehicle can cost. So if you have one of these vehicles, make sure you check on the qualifications, and there are many resources on the IRS website so you can determine if you and your vehicle qualify. If you purchased your vehicle in 2022 or earlier, you may still qualify. This is a little bit more difficult to qualify for because the IRS has been phasing it out for manufacturers who have sold more than 200,000 electric vehicles in the United States, which, given the recent popularity of the electric vehicles, this is a little bit more of a challenge. However, it is still worth checking it out. And there is a list on the IRS website. We've included the link on this PowerPoint showing you the complete list of manufacturers and models that would still qualify for this tax credit. We also have other tax credits for used vehicles. So if you purchase a used electric vehicle in 2023 or 2024, you may still qualify for a tax credit, the used credit or the previously owned vehicle credit. You still must buy this from a licensed dealer. Individual resales are not allowed. So purchasing an electric vehicle off of Facebook from just a normal unlicensed individual would not allow you to qualify for this. So this is kind of another benefit of going to a licensed dealer. The credit is going to be a maximum of $4,000 or 30% of the sales price. The vehicle must be $25,000 or less in order to qualify for this credit. So even if your vehicle reaches the max price of $25,000, you still would only be able to deduct $4,000. Purchases prior to 2023 for used electric vehicles do not qualify for this credit. Here are the list of qualifications in order to get the used clean vehicle credit. And just to reiterate, you must buy it from a licensed dealer, and you must be using it for original purposes. You cannot be the original owner. You cannot be dependent on somebody else's tax returns, and you cannot have claimed another used clean vehicle credit within 3 years prior to the purchase date of this particular vehicle. Again, there are adjusted gross income amounts that you must qualify for. And you can visit fueleconomy.gov to see if your make and model qualifies for this credit. If you are unsure about the specifications of your vehicle, all the information should be located on your vehicle's window sticker. If you are still unsure, fueleconomy.gov is a great resource to check on your particular vehicle and specifications. To claim this credit, make sure to file the 8936 clean vehicle credits with your tax return. For new clean vehicle credits, be sure to include your vehicle's VIN so that the IRS can double check the information you have provided. The IRS is also offering home energy improvement credits. The home energy efficient home improvement credit gives you 30% back. There is now no more lifetime limit, so you can qualify for $1,200 annually. This includes water heaters, heat pumps, biomass stoves, and biomass boilers that will give you a separate $2,000 annually if you add these to your home. You can also qualify for residential clean energy property credits, such using solar panels or wind turbines on your property. Of course, these are a little bit more difficult to implement as there are HOA rules and restrictions. However, solar panels are a great opportunity to register for a home energy credit and to lessen your electricity usage. So you can get a 30% tax break for expenses related to these qualified home improvements that use alternative power, and there is no limit on these.
Next, we're going to talk about House Bill 7073, which has added many tax savings for 2024. First, we're going to talk about property tax relief. First, Florida has had property insurance tax relief for homeowners, on insurance policy owners, and on flood insurance policies. So this is definitely something to look at if you have purchased insurance. Next, they are going to add a $25,000 homestead exemption. This amendment will be considered by Florida voters at the 2024 general election, and it's expected to save Florida homeowners $22.8 million and then growing by 2028. Next, we're going to talk about the 2024 sales tax holidays. They're coming back around. We had them for 2023, and we're going to have them again. So the first one is the disaster preparedness sales tax holiday, which is from June 1st to 14th and August 24th to September 6th. This is to get ready for hurricane season, and this allows you to not pay sales taxes on things like flashlights, lanterns, radios, portable power banks, batteries, things that'll help you get ready for the storm season. The next one is Freedom Month. So from July 1st to July 31st, you're going to get sales tax breaks on fun summer events, admissions to music, sporting and events, movies and museums, going to gyms, tickets, membership passes, boating equipment, camping equipment. All your summer activities will be, well, most of your summer activities, definitely look at the list, will be sales tax free. The next one is the skilled worker sales tax holiday on tools, which is a 7-day tax holiday in September for certain tools used by skilled trade workers, such as hand tools, power tools, work boots, safety equipment. So again, as we're moving into hurricane season, and if you are a skilled trade worker, getting equipment for your job, this is a great way to save some money on that. Next, we're going to talk about the direct file pilot. So this is something new for 2024 for filing your taxes. I know we're only 10 days away, so I'm sure many of you have filed your taxes already, but if you haven't yet, this is a great way to help the IRS out and participate in a new great program. So the program is a new way to file your taxes. It only supports simple tax needs, but it makes it very easy for you to use. It'll walk you through the process, give you a step-by-step checklist, show you a clear summary of your taxes, and it also gives you the ability to get support from the IRS staff if you do have any questions. It's also super easy to use. You can do it from your smartphone, you can do it from your iPad, you can do it from your computer. The goal of this is to make taxes very accessible. It does come with a list of requirements. You are allowed to do it in the state of Florida, but only if you have taxable income from no other state. So you need to be able to prove your identity, and it only covers simple tax needs. So you can only use it if the only income you have is from W-2s, 1099-Gs, SSA 1099s, and 1099-ins. Your income also has to be under $200,000, which is a much higher threshold than the other programs that the IRS offers to free file your taxes, which is what makes this such a good program. Additionally, you can only take the standard deductions. You can't have HSA contributions. You have to just be only claiming those 3 tax credits and have an account with the IRS. Again, this is for simple tax needs, but if you do have only these forms of income and you're going to take the standard deduction, this is a great way to file your taxes this year in the next 10 days.
So now we move on to issues of delinquent tax returns and what is an extension. So as we mentioned, tax day is in about 10 days, April 15th. So if you have any issues finishing your tax return on time this year, it is okay. The IRS does offer an extended due date by about, I believe it is 6 or 7 months, leading us to October 15th. You can request your extension of time to file. You have to file that prior to April 15th, the regular due date. However, there is some important limitations to this extension. A filing extension is not the same thing as a payment extension. If you request a filing extension, you still must pay your estimated taxes by the regular due date. Your payment due date is not affected, meaning that you will still owe estimated taxes on April 15th, even if you have the October 15th extension. So the other issue that comes with this is that if you even have a filing deadline, it is important, or an extended filing deadline, it is still very important to meet that deadline. Until your return is deemed properly filed, the statute of limitations does not begin to run. A statute of limitations is a time period that is established by law to help protect taxpayers from endless liability and endless scrutiny. The statute of limitations does differ depending on the issues found in a return or the issues that you have in general. So we gave some examples of the statute of limitations currently. So the IRS must assess taxes owed within 3 years of receiving a return. Assessing means they will determine the amount owed based on the return you filed. The IRS must collect taxes, penalties, and interest owed within 10 years of the assessment date. Collection means they are actually going to you to receive the amount owed that they have already assessed. You must claim a credit or a refund from a specific year on the later of 3 years from the date you filed your return or 2 years from the date you've paid your tax. This is important because, as you know, you are able to amend your returns to lessen your tax liability, but if you fall outside of the statute of limitations, you will not qualify for a refund from those years. Generally, the IRS can audit returns filed in the last 3 years. Given how long the process of auditing takes, they typically will not go for any returns that are pending on their 3rd year. If this does happen, the IRS may ask you to sign a waiver on your statute of limitations. Although this does seem counterintuitive, this is actually in your best interest to waive the statute of limitations when you are in the middle of an audit. If you choose to not extend the time period, the IRS will assess the tax against you based on the information it currently has. Meaning, if you have not had the opportunity to fully appeal their audit results, provide further documentation, or completely explain your position, you will be stuck with whatever the IRS has deemed you to owe in that moment. Now we'll move on to offers in compromise, what to do when you have a delinquent tax return or an audit and the amount you owe. So an offer in compromise is an agreement between a taxpayer and the IRS that settles the taxpayer's liabilities for less than the full amount owed. This is especially useful because although the tax penalties may be high, there may be other interest involved, it is not always feasible to expect everyone to pay that back within one lump sum payment. So the IRS does accept offers in compromise to help lessen the burden on taxpayers. There are 3 examples of when the IRS will accept an offer in compromise. The first is when there is a doubt as to the liability. This means that there is a genuine dispute as to the existence or the amount of the correct tax debt owed under law. Meaning that the IRS may say that you owe $5,000, but you have determined that you do not actually owe $5,000 and may only owe $1,000. That is a doubt as to the liability. The second is a doubt that the amount owed is fully collectible. This means that the taxpayer's assets and income are less than the full amount of the tax liability. A taxpayer does not necessarily need to be completely insolvent in order to qualify, but your assets and income do have to be under the amount of tax liability owed. The third is effective tax administration. Here is where there is no doubt that the tax is legally owed and that the full amount can be collected. However, requiring payment in full would create economic hardship or would just be unfair and inequitable because of exceptional circumstances of the taxpayer. So this one provides you a little bit more leeway to explain these exceptional circumstances and why you cannot afford to pay at this moment. So to submit an offer in compromise is not extremely technical or difficult. You have to collect the proper documentation and submit the required form, as well as pay the application fee. For doubt as to collectability or doubt as to the effective tax administration, you must submit a Form 656, a 433A for individuals, or a 433B for businesses. For doubt as to the liability owed, you submit a Form 656L. For the application fee, there are certain waivers involved. If there is a doubt as to the liability owed, no fee is required. And also, if your adjusted gross income falls below 250% above the poverty limit, you can qualify for a low income exception to waive this application fee. An offer in compromise provides you with two payment options. The first is a lump sum cash offer. This offer is payable in 5 or fewer installments within 5 or fewer months after the offer is accepted. In order to qualify for a lump sum cash offer, you must include a non-refundable payment equal to 20% of the offer amount when submitting the form requesting an offer in compromise. This might seem a little steep if your offer amount is a little bit higher than what you would like it to be. However, it is a very good opportunity to show the IRS that you are fully willing to cooperate and want to get this fixed as fully as possible. The second offer is the periodic payment offer. This is payable in 6 or more monthly installments and within 24 months after the offer is accepted. This gives you a little bit more leeway and a little bit more time to ensure that you can properly pay off your taxes without endangering your finances. This also must include a non-refundable proposed installment payment along with the required forms. This payment is required in addition to the application fee unless you qualify for the exception to the application fee, of course. Also, the IRS is evaluating a periodic payment offer. You must continue to make the non-refundable installment payments offered. So even if the IRS has not actually reviewed your offer completely and offered you a final determination on whether they will accept that offer, you still must make your payments in order to qualify for the periodic payment offer.
Next, I'm just going to go over some key takeaways from this presentation. For sports betting, make sure you report all of your winnings as they are taxable. For the payment providers, make sure that you are not reaching the reporting threshold. And if you do, make sure you're filing your taxes on those. Watch out for the forms that those payment providers will send to you at the end of the year so you can file your taxes properly. For retirement savings, you can look to additional withdrawals if that's something that would be helpful with no penalty. Look through the qualifications to see if you can roll over any 529 leftover plan funds. And remember that you no longer have to take RMDs for Roth 401ks. For the green energy requirement, make sure that you meet all of the requirements when you purchase an electric vehicle. And it's definitely something to look out for because it can be a great way to save money and to help the environment. Under House Bill 7073, there are sales tax holidays coming. Plan for them with your purchases so that you can take advantage of this opportunity. Same with the direct file pilot. If you have not yet filed your taxes in the next 10 days, this is a great way to file your taxes for free and to take advantage of this new pilot program. If you are requesting an extension because you don't plan to get it done in the next 10 days, just remember a filing extension is not a payment extension. And the last thing we talked about, offers in compromise. It can be a great way to reduce your delinquent tax burden if you don't feel like you're able to meet it. Thank you so much for listening to us.
Thank you so much. That was some terrific information. I did have one question at this time. So you mentioned with IRAs that they'll be reducing or eliminating the penalty for touching them before 59.5. Does that apply to traditional and Roth or just Roth?
I think that's for both, right?
Okay.
Savannah and Hallie. Yeah. So the exceptions to take that penalty-free withdrawal for like if you're up to 10,000, if you're the survivor of domestic violence or that emergency $1,000 chunk, that applies across the board.
So I want to thank each of you for all this great information and taking time to be with us for this episode. And I want to thank our audience for joining us. And if you have any questions, please comment and we will do a follow-up. And let you all know our next Law in the Library session will take place on Wednesday, May 8th at 5:30 on Facebook. Thanks for tuning in.